he is, Michael Burry was one of the few investors who predicted the housing bubble before the whole market collapsed.
So Michael Burry obviously is the guy from The Big Short. Michael Burry's much more sophisticated than I am, but I'll say this, that Michael Burry does have a history of getting in too early. He was investing, I think, in these water desalination kind of companies, or water treatment companies, which is a little early. We're not in the water crisis yet. And I don't know how he was investing. I don't know what the type of investment was. I don't know if it was a security, or if it was like some kind of participation program or what. But it's a little bit too early for that. He was also investing in gold holding companies, and I don't see any huge crisis, coming down the pipeline that would kind of, warrant that. But, he's an extremely smart guy.
In 2008. And he ultimately ended up profiting over $100 million personally and making over $700 million for his investors off of that trade. So if you've been watching the markets at all in recent years, you've seen the continued rise in indexes like the S&P 500, which has hit a new all-time high 50 separate times in 2024. So a lot of investors are thinking this can't keep going up forever, right? Well, they're not alone, with many famous investors either asking the same question or even selling huge amounts of their stock positions. And Michael Burry in particular is interesting since he's correctly called every last major stock market crash. He shorted the dot-com bubble in the early 2000s. He famously predicted and profited from the subprime mortgage crash.
And I'll say this too, if you're a pessimist a lot, you're eventually going to be right.
That kickstarted the Great Recession. He made a fortune shorting Cathie Wood's ARK Innovation ETF during the tech crash in 2021.
So there was that's funny, Cathie Wood's, they had an inverse ETF, which means just people were betting against Cathie Wood's. And it made sense. Look, they were raising rates. Growth in tech usually gets very compressed. They get crunched when that happens. So it wasn't a big surprise.
Love him or hate him, this guy has made a lot of money off of his market predictions. But after deleting his Twitter in 2023, Burry has gone silent on the markets, at least publicly.
And that's what I said about when I first did my introduction video. If you know how a lot of these systems work, so you can kind of predict, you can kind of have like a crystal ball and see into the future if what you expect to happen happens. What I mean by that is that if you thought the Fed, which they said they were going to do over and over and over again, were going to hike rates, you knew these things were going to happen. You could kind of get ahead of them.
Publicly. But we can get an indirect look into what Burry is thinking by looking into the SEC filings from his fund, Scion Asset Management. So let's see what stocks he's been buying and selling and see if you can spot the pattern. Sale, the real Inc. Sale, American Corporate Inns Corp. Okay, interesting. Buy Alibaba. Buy Baidu Inc. Buy JD.com. And he had a bunch of puts. Remember, these reports aren't in real time since these are Burry's trades from last quarter. But what do all these stocks have in common? Well, they are, all of them, Chinese stocks.
China. On the Chinese economy.
The Chinese economy.
And
okay, and I'll say this, that's not a unwise move, right? China hasn't been doing well, so stuff is discounted. You don't see the high multiples in China like you do in the US, and China's proven to be a pretty good player. So, investing is just kind of like surfing in a way, right? If you swim towards the wave, you've already missed it, right? You got to kind of position your board, and I'm quoting what's his name? This isn't my own quote. This is someone else. I just can't think of the person's name. You position your board to catch the next wave, right? So you stay in that position. So that's really what he's doing.
The sales, American stocks.
reality is inflation remains high.
Trump will be
remains
the
sticky.
47th president.
Growing concern that inflation could actually take even
The Fed's
higher.
job is likely not done.
Okay, wait. That doesn't necessarily mean that Burry thinks that American stocks are overvalued. Maybe he just really likes Chinese stocks. Maybe, except for before Burry deleted his Twitter, he left us with the exact warning signs to look for before the next stock market crash. And it looks like he's acting on those signs, both with his sales of US stocks as well as his strategy of buying and hedging his Chinese bets. So let's look at what Burry might be seeing in the market, and more importantly, what you can do to protect yourself.
So this was in the video I thought it was. I've seen this guy talk before, and there was something to criticize heavily on it, but this isn't the one, but we'll continue.
Back in 2019, Burry issued a warning about a bubble brewing in the ETF market, saying that passive investing was artificially inflating the values of stocks, just like CDOs had inflated the subprime mortgage bubble in 2008. But investors at the time mostly dismissed him, with Elon Musk comparing him to a broken clock, and Twitter users saying Burry had predicted 6 of the last 0 stock crashes. Even Tom Nash got in on the fun. But after a crash caused by the pandemic in 2020, followed by an even faster rise in stock prices, it started to look less like Burry was wrong and more like Burry was just too early.
Beware of day trading options. It's one of the fastest ways to lose all of your money. This is what some people will keep telling you because they have never traded options and they don't know how straight.
Insane.
Wouldn't be the first time. The housing market didn't crash until 2008, but Burry was predicting that crash way back in 2005. And now, 5 years later, there's something happening in the US stock market that is causing Burry to sell his US positions. And it all centers around this idea of passive investing. Okay, so passive investing, there's really only 2 ways to do it. You can buy an index fund, or you can buy an exchange traded fund, or ETF for short. If a single stock is like an
Okay, this is the thing that drives me nuts. There's multiple. You could invest in a direct participation program. So first of all, there's another thing wrong too. He's using the term passive income wrong. You can, like, collecting rent from a second home is passive income. What he's talking about is portfolio income, and they're classified by the IRS differently. So an ETF, you can leverage an ETF. A index fund is also, well, it can be open or closed fund, so I'm not going to say it's like a mutual fund, but what index fund are we talking about? Are we talking about the Wilshire? Are we talking about the Russell, S&P 5, 1, 2? What are we talking about? And also too, if you do that, I mean, it depends on what type of ETF you have. You could have some resilience within the ETF, but if you're doing index, and let's say you are a risk averse person, you're going to get some shocks, and it might not be good for your investing mentality, let's say. So what he said was completely wrong. There's many different instruments that you can use for portfolio income as well as passive income. So this to me now is one of these guys who just knows a little bit, but some people know less. So he sounds like he knows what he's talking about. And keep in mind, I'm an industry professional and I have a degree in this. And I'm not trying to put myself in the hill. Look, I just had my Dunning-Kruger Valley of Despair moment, years ago, and it took me a long time to get there. But this isn't a guy that you should be listening to. There's plenty of good people out there that you could be listening to get a better education, just based on that. But there was something else I saw too. All right, I'm gonna shut up now.
Ingredient in your portfolio. An index fund is like a grocery basket that contains all the ingredients you'd need to cook a recipe for the entire market. You buy every ingredient or
False.
or in this case, a little piece of every stock in the market that the index tracks. So for example, if you're tracking the S&P 500, you could get little pieces of the 500 biggest companies in the US. ETFs, or...
And just a little fun fact, and that sounds like a managed company, which is good. But I guess if you went back to the S&P, what was it, 20 years ago, half the stuff on the S&P 500 are no longer there, and I think 20% of them no longer exist.
Exchange traded funds are similar, but they're like ready-made frozen meals. They give you a bunch of stocks in one purchase, but unlike index funds, you can buy and sell ETFs throughout the day. So both index funds and ETFs,
you don't redeem them at net asset value like a mutual fund, and they can be leveraged.
Make it easy to invest without picking individual stocks, and common wisdom has been that slowly investing in ETFs and index funds over time is the best way for most investors to grow their money.
You said in the 1996 annual report that most
And people look at this clip as gospel. This is, gosh, I think this was taken in 2003. Warren Buffett's about to talk about the S&P. And listen, it's not a bad strategy. Indexes do really well, but it doesn't necessarily, I'm going to use the word necessarily, you want to put some resilience into your portfolio, right?
investors will find that the best way to own common stocks is in an index fund.
So I would pick a broad index, but I wouldn't toss a chunk in at any one time. I would do it over a period of time.
And the idea of passive investing makes sense. The average active trader will end up with average results, but they also have to pay extra fees for trading or management. So by investing in every single stock in the market through something like an index fund, you can get the same average returns, but without all those extra costs. This style of investing...
Wait a minute. If you buy let's say an open-end fund, index fund, right? There's going to be management fees. You just don't. There'll be management fees, and if you buy A-class shares, you're going to get those front-end fees. You buy B-class shares, you're going to get the back-end fees. If you hold the B-class shares for a long time, you might get those fees will decrease. Can decrease to nothing.
It really took off in 1976 when John Bogle introduced the first index fund for Vanguard, but it has absolutely exploded in popularity recently. Since the 1970s, the percent of adults who are invested in stocks in general has steadily increased. Here's an article the New York Times published in 1975 reporting that just 25.2 million people owned stocks at the time. But today, that number is closer to 61% of Americans, or over 230 million people. So more investors than ever are jumping into the stock market, and the amount of them investing passively is also growing. And it's this combination that is making Michael Burry so worried. Here's a chart of the amount of money invested with active funds like hedge funds or mutual funds over time. And here's a chart of the amount of money being passively invested. So you see that point on the top right? Passive investing has grown in popularity so quickly that for the first time in history, passive investing has surpassed every active investment in the market combined. And this has more than just Michael Burry worried. If the market is mostly owned by people who don't care about the specifics of the stocks they buy, what effect does that have on market prices? Well, here's what Charlie Munger, Warren Buffett's right-hand man, has to say about index funds in that same clip from earlier.
Common stocks could become so high-priced that if you bought index funds, you wouldn't expect to do very well. I didn't think I'd live long enough to think that was likely to happen, but now I think that may happen.
Welcome to OCC Learning, an e-learning platform where investors can find realistic options education for free. Join now to learn at your own pace with...
Okay, just to crap in this person's commercial, there's someone called Series 7 Guru. If you spend about 4 hours listening to him, plus maybe 5-10 minutes a day practicing, doing options questions, you can learn it without paying a dime. How about that?
So this clip really got my attention. Like, this guy isn't like Michael Burry. Charlie Munger is one of the most conservative investors out there. So I dug deeper into why these big investors are so worried. And the big thing that comes up is something called price discovery. So if you think of a stock, let's say Apple, the price of the stock should be whatever the market on average is willing to pay for it. But this concept of price turns out to be a very fickle thing in the stock market. So price discovery. Imagine you're at an auction and someone is selling a rare baseball card. The card's price isn't set by the seller, it's decided by how much people are willing to pay for it. Some bid low, others bid high, and the final price reflects what the group thinks the card is worth. And for stocks, this happens every second the market is open. Buyers and sellers look at things like company profits, new products, or the economy to decide what a stock is worth. And this back and forth is what keeps stock prices tied to their real value based on what everyone knows, wisdom of the crowd. But now with passive investing dominating the market, this price discovery process could get broken. When you buy an index fund or an ETF, you're not checking if every single stock is worth the price, you're just buying the whole basket. So if a stock is part of that basket, people are willing to buy it simply because it's in there, not because it's necessarily a good investment. For example, Apple stock might be worth $200 based on its business. But if billions flow into funds that include Apple, its price could rise to $250 just because people are buying the basket. And that extra $50, it would be artificial demand, not tied to the stock's real value. So, okay, maybe passive investing is pushing prices up, but passive investing has existed for a while, so we need to look at what has spooked Burry into selling now, figure out which industries could be the hardest hit if a bubble bursts, and most importantly, how regular investors like us can protect ourselves. So why, after 5 years, is Burry selling now? Well, a lot of investors are uneasy about how much the stock market has grown. I mean, look at a chart of the S&P 500. It's up nearly 90% over the past 5 years. But that big growth hides a bigger problem, which has only gotten worse in the last 12 months: concentration risk. So here's the official definition of concentration risk. When your portfolio is too focused on one type of investment, you can lose a bunch of money if that one investment goes down.
And that's what I said earlier. You need to build some resilience in your portfolio. You have to do it, especially when, okay, and this is not investing advice. This is just for your own information or education. I'm not suggesting you change your strategy based on this, okay? But, you know, if everything, you know, you don't want to sell, you don't want to, buy high and sell low, right? If you have a, for example, if you have a, let me just say this, if you have a balanced fund, for example, right? You know, part bonds, part stocks. If the market does, in fact, take a dip, right? Your fund is going to take less of a hit, right? So, you know, even some of those ETFs that he was even talking about have those built in. So, you know, that being said, you know, going pure index has its own type of risk. You're getting less management fees, but is that going to be worth it at the end if you have like a really good investment advisor or financial advisor, CFP or CFA?
It's like a group project in school where just one or two people are doing all the work. So if those people stop working, the whole project can fall apart. That's what's happening right now in the S&P 500. A huge chunk of the S&P 500's growth is coming from just a handful of big tech companies: Apple, Microsoft, Amazon, Nvidia. According to Goldman Sachs, the top 10 companies in the S&P 500 now make up a third of the index's value. That's even more concentrated than during the dot-com bubble of the 2000s. So now if those few companies...
So basically what he's saying is that people ask me this question all the time, like what stock do I buy? What stock do I buy? And one, I can't answer that because I can't make blanket recommendations. Two, I have to look at suitability, right? Three, if I answer that and that you just go put all that money in one basket, you open yourself to what's called business risk, which is a concentrated risk. So you need to diversify. You need to diversify with usually with negative correlated securities in order to build resistance, low to negative, I should say.
Companies run into trouble, it could drag down the entire S&P 500, even if the other 490 companies are doing fine. So how can a normal investor avoid that risk? Well, the best tool to counteract concentration is diversification, spreading your money out across many types of investments. This way, if one area struggles, the other might hold steady. So let's look at some options that people talk about to diversify. So first, maybe we can invest in crypto like Bitcoin or Ethereum. People often talk about these investments as a store of value or a hedge against inflation. And inflation is definitely hitting people's wallets even after some cooling in.
Okay, all right. So let's just go historically, all right? Has Bitcoin or any other coins, when an index like the S&P falls, have they gone up? No, that's horrible advice. That's not how you hedge it.
But here's the catch. If we look at the correlation between Ethereum, Bitcoin, and stocks, we can see that they've become more connected over time. So while it's exciting and volatile, when stocks drop, crypto usually drops too. Okay, so maybe real estate. Well, it can offer some protection, but over the years, the real estate market has started to move more and more in sync with the stock market, making it less of a safety net during crashes. So okay, let's leave the US.
Yes, but it's the first to recover as well, with the exception of 2008. And usually the housing market does fairly well after a stock market crash because they lower interest rates. And when they lower interest rates, the 10-year goes down. When the 10-year goes down, mortgage rates go down. When mortgage rates go down, prices, people can now buy into the market. You can buy more house. So that's not totally correct, right? Maybe the knee jerk, but not in the big picture.
And look at Chinese stocks, where Burry has been putting his money, specifically in Chinese tech stocks. So China's government has recently been pumping huge amounts of stimulus money into their economy, nicknamed the Chinese stimulus bazooka, because they're basically saying, we just want growth at all costs. This has some echoes of the US stimulus from the early 2020s, which fueled a massive stock market rally, especially in tech, along with a bunch of inflation. So Burry may feel that US tech stocks already had their pump cycle, and now he's moving on to China as they start to follow the same path. But taking everything together, if there really is a passive investing bubble in the market, let's look at what regular investors can do right now to protect themselves. So
I made over 6 figures trading without even looking at the charts.
Sure you
without
did.
Spending hours glued to the screen, and without relying on someone else to give me an alert, a trading signal, or having to join a Discord group. So what did I do instead? I followed a set of mechanical rules, a strategy that allowed me to minimize my losses and max.
Look,
So let's look at this from first principles. If
there are a very, very small select few that can make money like that. But besides technical analysis, they look at fundamental analysis as well. And they do that 24/7, and they look just if you see a commercial like that, please don't buy into it.
Burry is right, and a bubble is getting ready to burst, we only have a few options available. Option 1, we could sell our stocks and go into cash, but that's probably the worst option overall. If there is a big market crash, especially if a recession comes with it, the Fed is probably going to do something. Generally in a recession, the Fed will lower interest rates to stimulate the economy. But when interest rates are lowered, that increases the amount of money flowing through the system, which causes higher inflation. So anyone who goes to pure cash would see their money very.
Whoa. Okay, it's if the stock market crashed, right? It's usually because of the economy is crashing. Usually, right? Usually. If the economy is crashing, that the putting extra cash into the market is supposed to stimulate the economy. right? So it's not necessarily, you're not necessarily going to see the huge inflationary pressures like you saw during the pandemic, right? Look at 2008, right? 2008, 2010, you had deflation, and man, those printers were freaking hot. They were printing money.
Quickly get whittled away by rising inflation. I know I've seen the effects of inflation every week when I go grocery shopping. And when inflation is high, staying invested in the stock market is one of the best ways to avoid losing money to inflation. So option number 2, we could try to time the market, selling out before a potential crash and then buying back.
Now, you might get the idea from how I talk that, I'm trying to time the market, or do some asset allocation or tactical allocation. For the average person, that's not going to work, right? And this has been proven, empirically proven. A person that does that at the end of their investing journey, they make half as much as a person that just stuck with their strategy and stayed in it. For example, like a managed fund of some sort.
In at the bottom. So Charles Schwab actually ran a study about this sort of strategy, comparing 4 investing styles over 20 years. They had 4 people, person A, B, and C, who each invested once per year for 20 years straight. Person A perfectly timed the market by buying at the bottom each year. Person B just invested consistently on the same day each year. Person C had horrible market timing and bought at the peak of the market every year. And person D just stayed in cash and bonds. So Charles Schwab simulated the results of each strategy over 20 years, and the results were pretty clear. Staying in cash was by far the worst, but the left side was more surprising. So if you had perfect market timing, you only made yourself around 8% more than just investing consistently over 20 years, while bad market timing cost you closer to 12%. And this is a simplified version of what many in-depth studies have shown. The potential win from timing a market crash successfully isn't worth the risk of timing it badly. You lose more than you win, and you lose more often trying to time it. So your best bet is just to invest consistently. But let's look at option 3, which is what I will be doing in the case of a market crash. First off, I probably won't be buying Chinese tech stocks because 1, there aren't as good regulatory protections for Western investors in China, and 2, unless you have Michael Burry's perfect timing, buying Chinese stocks is actually very correlated with buying US stocks. So it doesn't protect you in a crash. If US stocks drop, these stocks will probably drop too, and they're more risky due to different regulations. Instead, what I am going to be doing is a mix of putting around.
And here's one more thing you didn't mention too, like the dollar at those times becomes safe havens, and if you have your money in Chinese stocks, there's going to be some like currency risk in there too.
Around 15% of my income into a passive broad market index fund, which has consistently been shown to be the best way to retire with money. Now, as long as I don't need to pull any of that money out in the next 5 years, investing over a long time horizon helps reduce that concentration risk in these big tech stocks. And second, I'll continue to buy undervalued stocks with a 5 to 10 year time horizon with any extra funds I can scrape together, because consistently putting more money into the market is the best way to build wealth, and time in the market beats timing the market. But then there's the other case where Burry is wrong and there is no bubble. Well, in that case, consistently putting money into the market also works. Like in the last 5 years, people who stayed invested in the market made far more money than anyone who sold back in 2019. Now, it is interesting what Burry is seeing in the Chinese economy that is making him put those new hedges against his Chinese stocks. But that'll have to be the next video. My plan for now is to keep it stable and keep it invested.